Preparing for a financial analyst at CaixaBank interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at CaixaBank? CaixaBank appeals to me because it combines a leading retail franchise with meaningful corporate, wealth, and digital banking activities. I want an analytical role where financial analysis directly supports customers, risk decisions, and sustainable growth. My strengths are structuring information, questioning assumptions, and communicating conclusions clearly. I am also attracted to CaixaBank's emphasis on technology and responsible banking. That combination would let me develop technically while contributing to decisions with visible economic and social impact. While answering, connect your analytical skills with CaixaBank's retail and corporate banking scale, Spanish market presence, customer focus, digital transformation, sustainability agenda, and your motivation to support sound commercial decisions. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows performance over a period, the balance sheet shows financial position at a point in time, and the cash flow statement explains changes in cash. Net income increases retained earnings and starts operating cash flow. Depreciation reduces accounting profit but is added back because it is non-cash. Capital expenditure increases assets and reduces investing cash flow, while financing changes affect debt or equity. Together, the statements explain profitability, liquidity, and solvency. Make sure to cover the income statement, balance sheet, and cash flow statement, then explain retained earnings, non-cash adjustments, working capital movements, and the requirement that ending cash reconciles across statements. Question 3. Which financial ratios would you use to assess a bank like CaixaBank? For a bank, I would prioritize return on tangible equity, net interest margin, cost to income, non-performing loan ratio, coverage ratio, CET1 ratio, liquidity metrics, and loan to deposit trends. I would also examine cost of risk and growth in customer funds. Unlike an industrial company, debt is part of the operating model, so leverage alone is less informative. I would compare each measure with history, peers, management targets, and the prevailing interest rate environment. In your answer, talk about profitability, asset quality, capital, liquidity, efficiency, and valuation ratios, explaining why bank-specific metrics differ from industrial companies and how ratios should be analyzed through trends and peers. Question 4. How would higher interest rates affect CaixaBank's financial performance? Higher rates can initially lift net interest income if loans reprice faster than deposits, especially when floating rate lending is significant. Over time, deposit competition may increase funding costs and compress the benefit. Higher rates can also weaken borrowers, increasing provisions and defaults, while affecting bond valuations and demand for mortgages. I would therefore analyze asset and liability repricing gaps, deposit beta, hedging, credit performance, and management guidance rather than assuming rates are universally positive. Be sure to mention net interest income, deposit repricing, loan duration, fixed versus floating exposures, credit quality, market valuation effects, customer behavior, and the difference between immediate and longer-term profitability impacts. Question 5. What is net interest margin, and what drives it? Net interest margin measures the spread a bank earns from interest-bearing assets after funding costs, usually relative to average earning assets. It is driven by loan pricing, deposit costs, asset mix, repricing speed, wholesale funding, hedging, and competitive conditions. For example, a floating-rate loan book may reprice quickly, while savings deposits may initially remain inexpensive. I would examine both the headline margin and underlying movements to distinguish sustainable improvement from temporary rate effects. Focus on net interest income divided by average interest earning assets, loan and deposit pricing, asset mix, funding costs, hedging, repricing timing, competition, and why margin trends require appropriate period and peer comparisons. Question 6. Explain International Financial Reporting Standards 9 Expected Credit Loss Accounting. International Financial Reporting Standards 9 recognizes expected credit losses before a default occurs. Stage 1 assets carry 12-month expected losses, while Stage 2 assets, following a significant increase in credit risk, carry lifetime expected losses. Stage 3 assets are credit impaired and also use lifetime loss estimates, with interest treatment affected by net carrying value. Calculations typically incorporate probability of default, loss given default, exposure at default, macroeconomic scenarios, discounting, and carefully governed overlays. While answering, distinguish Stage 1, Stage 2, and Stage 3 exposures, explain 12-month versus lifetime expected losses, significant increase in credit risk, probability-weighted scenarios, and management overlays. Question 7. How would you analyze a corporate borrower's creditworthiness? I would begin with the borrower's business model, industry position, customer concentration, management quality, and competitive risks. Financially, I would analyze revenue stability, margins, operating cash flow, leverage, interest coverage, liquidity, and working capital. I would then identify the primary repayment source, evaluate collateral and covenants, and stress revenue, margins, rates, and refinancing assumptions. Finally, I would assign a clear risk conclusion, explain mitigants, and distinguish temporary pressure from structural weakness. In your answer, cover business model, industry, management, financial performance, leverage, liquidity, cash flow coverage, collateral, covenants, repayment source, downside scenarios, and qualitative risks beyond reported historical numbers. Question 8. What is the difference between liquidity risk and solvency risk? Liquidity risk is the danger that a bank cannot meet obligations when due, even if its assets exceed liabilities overall. Solvency risk is the possibility that losses reduce capital below a sustainable or regulatory level. A bank can be solvent but temporarily illiquid, or liquid because of emergency funding while fundamentally undercapitalized. I would assess deposits, wholesale maturities, liquid assets, funding concentration, capital buffers, asset quality, and stress scenarios together because the risks can reinforce each other. Make sure to distinguish the ability to meet near-term cash obligations from the ability to absorb losses over time, then connect both risks to bank funding, capital ratios, stress testing, and regulatory oversight. Question 9. How would you build a financial forecast for CaixaBank? I would forecast the key business drivers first: loan volumes, customer deposits, interest rates, net interest margin, fee income, expenses, and credit costs. I would separate recurring trends from one-off items and reconcile each assumption with historical performance, management commentary, macroeconomic data, and peer evidence. Then I would project earnings, capital, and liquidity under base, upside, and downside cases. Finally, I would test sensitivities to rates, volumes, costs, and provisions. Focus on revenue drivers, loan and deposit volumes, margins, provisions, operating expenses, capital, scenario assumptions, historical calibration, management guidance, and sensitivity analysis rather than mechanically extrapolating prior year results. Question 10. How do you value a bank? I would typically use price to book or price to tangible book alongside a dividend discount or excess return model. For banks, equity value is more meaningful than enterprise value because debt is a core funding source. The central question is whether sustainable return on equity exceeds the cost of equity, adjusted for capital needs and risk. I would normalize earnings, assess asset quality and provisions, forecast capital generation, and compare valuation with peers and historical ranges. Be sure to mention price to book, price to tangible book, dividend discount or excess return models, return on equity versus cost of equity, capital requirements, asset quality, and why enterprise value multiples are less suitable. Question 11. What is CET1 capital, and why is it important? CET1 is the highest quality form of bank capital, primarily common equity and retained earnings adjusted for regulatory deductions, divided by risk-weighted assets. It matters because it absorbs losses and protects depositors and financial stability. A bank's buffer above minimum requirements influences lending capacity, dividends, buybacks, and resilience under stress. I would analyze both the ratio and its drivers, including earnings, provisions, distributions, asset growth, portfolio mix, and changes in risk-weighted assets. In your answer, define Common Equity Tier 1 capital relative to risk-weighted assets, explain loss absorption, regulatory buffers, capital generation, distributions, risk-weighted assets, and the distinction between reported and fully loaded measures. Question 12. Tell me about a time you found an error in financial analysis. During a university finance project, I noticed that projected cash flow was unusually strong despite rising working capital. I traced the model and found that inventory had been treated as a cash inflow rather than an outflow. I rebuilt the schedule, quantified the valuation difference, and explained the issue to my teammates without assigning blame. We added balance checks and an assumptions review before submission. The experience reinforced that reasonableness checks are as important as formula accuracy. While answering, use a specific situation with a clear analytical error, explain how you validated the issue, quantified its impact, communicated it constructively, corrected the process, and describe the lesson learned. Question 13. How would you investigate a variance between actual and budgeted costs? I would first confirm that actuals and budget use consistent definitions and periods. Then I would decompose the variance into price, volume, mix, timing, foreign exchange, and one-off effects. For example, higher technology expense might reflect both increased licenses and accelerated implementation. I would speak with the responsible business owner, test the explanation against supporting data, assess whether the variance is recurring, and update the forecast or recommend action based on materiality. Make sure to cover price, volume, mix, timing, foreign exchange, one-off items, allocation methodology, operational drivers, materiality, management explanations, and whether the variance changes the forecast or requires corrective action. Question 14. What Excel and data analysis tools do you use? I use Excel extensively for financial models, including XLOOKUP, index match, SUMIFs, pivot tables, scenario switches, charts, and reconciliation checks. I structure inputs, calculations, and outputs separately so assumptions are transparent and changes are auditable. When datasets are larger, I am comfortable using SQL or Python for extraction, cleaning, and validation, then presenting results clearly. I also document sources, perform independent reasonableness checks, and protect formulas before sharing files. In your answer, mention practical Excel functions, pivot tables, charts, reconciliation controls, data visualization, SQL or Python if applicable, documentation, and how you protect accuracy when handling large financial datasets. Question 15. How would you assess the impact of a recession on CaixaBank? I would model weaker GDP, employment, property prices, and business activity, then translate those assumptions into slower loan demand, higher defaults, lower recoveries, and increased provisions. Mortgage, consumer, and SME portfolios may react differently, so segmentation is essential. I would also consider pressure on fees, margins, and expenses, then assess capital and liquidity under stress. Finally, I would include management actions such as pricing, cost control, restructuring, and portfolio de-risking. Focus on unemployment, GDP, property prices, loan demand, defaults, provisions, margins, fees, expenses, capital, liquidity, and scenario design, while separating first-order effects from management mitigations. Question 16. What are the main risks in a bank's mortgage portfolio? Key risks include borrower affordability, unemployment, interest rate resets, falling property prices, geographic concentration, and weak underwriting. I would review loan-to-value distributions, debt service burdens, borrower income stability, arrears trends, vintage performance, and exposure to variable versus fixed rates. Collateral reduces potential loss but does not prevent default or guarantee full recovery, particularly when prices fall or enforcement takes time. I would therefore combine portfolio statistics with macroeconomic stress testing and borrower-level evidence. Be sure to mention borrower affordability, unemployment, interest rate resets, loan-to-value, geographic concentration, property values, underwriting standards, prepayments, arrears, and how collateral does not eliminate credit risk. Question 17. How do ESG factors affect financial analysis in banking? ESG factors matter because they can change cash flows, asset values, funding access, and credit risk. Climate transition costs may weaken an emissions-intensive borrower, while physical risks can affect collateral and business continuity. Social and governance issues may create conduct, reputational, or operational losses. I would assess sector exposure, borrower plans, data quality, financed emissions, scenario analysis, and measurable targets. The objective is not simply reporting, it is integrating sustainability into pricing, underwriting, and portfolio decisions. In your answer, connect climate, transition, social, and governance factors to probability of default, collateral values, financing demand, reputation, regulation, disclosure, sector concentration, and measurable risk management actions. Question 18. How would you compare CaixaBank with another European bank? I would normalize the comparison for reporting definitions, one-off items, business mix, and geography. Then I would compare loan and deposit growth, net interest margin, fee mix, cost to income, return on tangible equity, cost of risk, non-performing loans, coverage, CET1, liquidity, and valuation. I would also examine each bank's rate sensitivity, digital capabilities, customer franchise, and strategic priorities. A higher return may reflect greater risk, so I would interpret profitability alongside resilience and capital. While answering, use consistent accounting definitions and compare business mix, profitability, efficiency, asset quality, capital, liquidity, valuation, geography, interest rate exposure, and strategic positioning rather than relying on one headline metric. Question 19. Describe a time you had to explain complex financial information clearly. In a group valuation project, several teammates struggled to understand why a small terminal growth change materially affected value. I reduced the explanation to 3 drivers: forecast cash flow, discount rate, and terminal assumptions, then used a simple sensitivity table. I avoided unnecessary technical language and checked understanding through questions. The team adjusted its assumptions and presented a more balanced conclusion. I learned that effective analysis is valuable only when the audience can understand and use it. Focus on the audience, the business question, simplifying without losing accuracy, using a concise structure or visual, checking understanding, and showing how your communication influenced a decision or improved collaboration. Question 20. What would you do if senior management challenged your analysis? I would first listen carefully and clarify whether the challenge concerns data, methodology, assumptions, or interpretation. I would recheck the source information and reproduce the calculation independently, then explain my conclusion with transparent evidence rather than becoming defensive. If management provides stronger information, I would update the analysis and document the change. If the disagreement remains, I would present both cases, quantify the difference, and recommend the conclusion best supported by the evidence. Make sure to mention listening carefully, separating facts from assumptions, rechecking data and methodology, remaining open to correction, explaining evidence calmly, and updating the conclusion when new information is genuinely stronger. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.